You're thinking of starting your own business. Congrats! Did you know that according to the most recent nationwide survey, small businesses make up 68.6% of Canada's economy and employ 8.4 million people? That's almost 8 times the amount of people who work for large businesses. And though we aren't here to give you professional business advice, we are going to walk you through a series of financial considerations you should think about before you start your business. Because your real-life questions need real answers. It should also be noted that we aren't tax or legal professionals, and professional advice should be acquired in those areas if needed. We'll start with choosing a designation. Then we'll discuss evaluating your budget and understanding debt. We'll also look at retaining employees. And finally, holistic financial advice, which is about balancing your personal and business finances in order to get started on the right foot. So let's get into it. Lesson 1, choosing a designation. You're probably familiar with the terms sole proprietorship, partnership, and corporation. But you may not know how each of these designations impact your finances, so allow us to clarify. A sole proprietorship is the kind of business you launch right away, as there's no legal separation from you as a person and your business. You simply register the operating name of your business with the province, either online or over the phone. And you file your business taxes and personal taxes together. Some of the benefits of a sole proprietorship are that you can write off all business expenses against the income you'll be making. There's less paperwork involved in the setup. You're taxed based on your individual tax rates, and you get to be your own boss. The challenges depend on the nature of your business, but it's really important to understand that, in this case, if your business were to be sued, then you would personally be sued. There is no layer of protection between your business and yourself. So, insuring yourself against the worst-case scenario is crucial if you go the sole proprietorship route. The benefit of a partnership is that business administrative tasks are shared between 2 people. It works on the 2 heads are better than 1 principle. Each partner files their taxes as an individual and splits the income and tax write-offs between them according to their percentage of ownership. The ownership is outlined in the partnership agreement, which is a contract between them that details some of the more significant issues, such as what assets each partner will contribute. These can be physical assets or intellectual property. Some of the challenges inherent in a partnership are that it requires more time to set up than a sole proprietorship, and each partner is personally liable for the business and the actions of the other partner. Incorporating, on the other hand, separates personal liability from the business. The challenges of incorporating are that the setup is more involved than both sole proprietorships and partnerships and may require tax and legal advice. However, there are resources such as affordable or even free software, online guides, and templates that you can follow if you are the do-your-own-taxes type. You can also start as a sole proprietorship and shift into a corporation designation if, say, you are wanting to test out a business idea before committing to it. Either way, once you are incorporated, the bookkeeping for your business takes on a layer of complexity and requires professional tax advice. But in general, incorporating separates you from your business in a tax sense and liability sense. Because of this separation, the income earned by the business builds equity for the business, but it doesn't automatically reflect on you personally. You will likely want to pay yourself a wage that allows you to meet your personal financial goals, while also making sure the business is building the equity it needs for its goals. It's a balancing act for sure, but spending a little more time to become incorporated upfront may protect yourself, your family, and your business down the line. And regardless of your designation, you'll need to look into insurance and registering with the Workers' Compensation Board, WCB, through WorkSafe BC. Lesson 2, evaluating your budget. Trust me, you're going to want to have your budget in order from day one to give you the best chance for approval down the line. It's pretty common for banks to want to see 2 years of financial records before lending to your business, so you want your records in order. Each designation has specific strategies associated with it, but in general, the things to consider are accounts payables and receivables, the cost of doing business, and cash flow management. Having an accountant set you up right from the get-go makes all the difference in getting the loan you need down the line. Checking in with your accountant on a monthly basis is a great way to stay on track as things change. People often have a budget in their head, but when they actually see it, either on paper, a spreadsheet, or an app, it makes a huge difference in actually following it. Like any budget, it boils down to the money going out, balancing with the money coming in. Business accounting refers to this as accounts payables, the things you have to pay for, and accounts receivables, the money you are being paid. When it comes to the money you're being paid, not charging clients the right amount can make or break your business. Estimating and bidding on jobs is a crucial skill that is worth getting advice from someone who has been in business longer to make sure you don't learn this part the hard way. Once you've got that right and your business is growing, it will take more admin time and effort to manage the balance between accounts payables and accounts receivables, which is why the first employee for many businesses, after yourself, is often a bookkeeper, someone who will take on the role of keeping those accounts in order. Which leads us to the costs of doing business. These can vary from business to business, but across the board, whether you are your only employee or have hired a bookkeeper, paying salaries is one of the main costs. There is also renting space or storage, buying tools or office supplies, paying for professional consultants like accountants and lawyers, and insurance to protect you from liability. not to mention taxes, travel costs, and advertising or promotional costs. These costs need to be accounted for in order to maximize your tax deductions, but also to ensure that you are charging the correct fees for your services and expertise. A lot of small business entrepreneurs are DIY types, but when it comes to managing cash flow, you really don't want to wing it. A major pitfall for new business is not understanding the tax they'll owe and setting aside income to cover it. Knowing how much income tax, GST, and PST you're going to have to pay can help you stay ahead of the cash flow. Lesson 3, understanding debt. Like we said, debt in business is pretty much a given, and it's not all bad. It's nuanced. Say, for example, as a business owner, you rely on a work truck. It may be worth spending more money in the short term on a more expensive vehicle. This way, you are bringing down monthly expenses on the maintenance repairs an older vehicle would need. It can have a positive impact on your cash flow and end up costing less in the long run. That said, there is a big difference between short-term debt, long-term debt, and destructive debt. The first step in debt consolidation is to get a very clear idea of what debt you have and the interest rates on each one. Going to your bank allows financial advisors to guide you on how to group them together under a low-interest loan or line of credit. If that's not an option, you can plan to pay down your highest interest debts first, as they are making the most impact. Then work your way down the list from there. But for this method to succeed, you have to structure your payments, ideally as automatic debits. Lesson 4, retaining employees. In industries that tend to be competitive for employment, like trades for example, having the right people on your team is crucial. Understanding where your strengths are and hiring to complement your weaknesses just makes good business sense. Still, having employees is an expense, and gets more expensive when you don't get it right. Human resource departments exist for this very reason. So make sure you're well informed, because a very common mistake is that people hire based on who they like. Just keep in mind you'll have to adjust your budget for these services, as well as payroll costs, income tax, and CPP remittance on behalf of your employees. Now, let's say you found the right person. How do you hold on to them in this competitive market? Think about how you, as a small business, can offer a more personal approach. Consider how you can be flexible where a big business can't. For example, you could offer personalized training and professional development. As a trades business, you could consider bringing on an apprentice and supporting them with their on-the-job training. The apprentices you train today could become your core workforce tomorrow, reducing turnover and setting up your business for success. You could also offer scheduling flexibility, or even let your employees choose when and how they want to be paid. These seemingly small accommodations can add up and make a big difference in an employee's life. Lesson 5, holistic financial advice. As a small business owner, your personal financial well-being is dependent on your businesses and vice versa. It's a balancing act of staying in tune with your needs and the needs of your growing business. Check in on the goals of both before making your plans, and then keep your personal and business finances organized as two separate entities. Yes, a lot of small business owners try and commingle their finances, and it just doesn't work. It's too easy for things to slip between the cracks, which causes more time and money to be spent on accounting, as well as stress if you get audited. So set them up separately and stay on top of it. This can look like a monthly review with your accountant over coffee, and maybe a yearly one for goal setting with your financial advisor. And as both your life and business change and grow, reviewing where you are in relation to your goals can make it clear if adjustments need to be made in order to meet those milestones. That's what holistic financial well-being is: having a clear 360-degree view of your ideal picture, planning for its success, and following through. So, we've learned about choosing a designation, evaluating your budget and understanding debt, retaining employees, and finally, holistic financial advice. And now that you know more about the financial reality of starting a business, we hope you feel closer to doing just that. Just remember, help is here if you need it, because your real-life questions need real answers. Thanks for joining us today.